All right, let's dive right into this. Welcome to today's Explainer, where we're going to tackle a claim that honestly probably sounds completely impossible right off the bat, getting a 12.08% return absolutely risk-free. Now look, I know exactly what you're thinking. In a world where your bank is maybe offering a couple of percent on a fixed deposit, the idea of double-digit returns with zero risk sounds like a total fantasy, right? But today, we're going to unpack some truly fascinating research and strategies laid out by self-made millionaire Adam Koo. We'll see exactly how this mathematical phenomenon has historically played out.
So let's just go ahead and address the elephant in the room. Is a 12.08% annual return completely risk-free actually possible? It's totally normal to be skeptical here. I mean, we're basically hardwired to believe that if something sounds too good to be true, it probably is. And you've definitely heard the horror stories. People having their life savings wiped out in the stock market basically overnight. But what if I told you that the danger doesn't actually lie in the market itself? The danger isn't how the average person approaches it. The secret we're about to look at fundamentally shifts how you need to view long-term wealth building.
Okay, so the absolute most crucial thing we need to do first is tear down the single biggest financial myth out there, that high returns require high risk. You hear this from financial advisors and read it in textbooks all the time, right? The idea that to make big money, you gotta gamble big. But the reality? High returns actually equal high financial intelligence and competence. Think about it like mountain climbing. If an untrained person decides to just go climb Mount Everest, that is incredibly high risk. They might not make it back. But for a highly trained, fully equipped professional, the risk is minimal because they have the competence. And that exact same principle applies to your money. And honestly, this is perfectly summed up by none other than Warren Buffett. I mean, the guy is one of the richest men on the planet, and he built his entire fortune purely through investing. He famously said, "Risk comes from not knowing what you are doing." People don't realize this, but Buffett is actually incredibly risk-averse. His first rule of investing is literally never lose money. And his second rule is don't forget rule number 1. He doesn't gamble. He relies on high financial intelligence to create massive returns with minimal danger. So how do we actually apply that exact mindset to our own money? Well, to understand this, we've got to look at the historical data for the U.S. stock market, specifically the S&P 500 index. If you zoom in on random one-year periods, the market looks incredibly chaotic. You've got years where it drops 16%, then down 20%, and then boom, it rockets up 31%. It's violent, it moves constantly based on short-term news, panic, and speculation. If you put your money in the market and you absolutely have to take it out exactly 1 year later, Adam Coe's research shows you've got a 26% chance of losing your shirt. That is a gamble. That's high risk. But watch what happens as we build on this and zoom out a bit. When you shift from a 1-year holding period to a 5-year holding period, the data changes dramatically. Over 50 years of stock market history, if you held your investments for literally any 5-year block, your risk of losing money drops from 26% down to just 10%. Suddenly, you have a 90% chance of making a profit. The longer you stay invested, the more all that short-term chaos just kind of cancels itself out, and the true upward trajectory of the market starts to take over. Now, take a breath and really consider this for a second. 0%. What happens if you invest your money into the overall stock market and leave it completely untouched for at least 10 years? According to the historical data stretching across 50 years of market history, your risk of loss drops to exactly zero. Zero. Every single 10-year period in that half-century resulted in a profit. The market crashes, sure. It corrects, it goes through recessions, but over a 10-year timeline, it has historically always recovered and grown. Time literally eliminates the risk. And here is the absolute kicker. What happens during that risk-free holding period? Historically, simply holding the U.S. stock market over the long term hasn't just kept your money safe. It's averaged a massive 12.08% return per year. Let that sink in for a minute. By just leaving your money alone in the broader market for over a decade, you capture the overall economic growth of the greatest companies in the world, averaging double-digit returns annually. The secret is literally hiding in plain sight. So how do you actually go out and execute this? Well, the mechanism is probably familiar to you. You use an index fund or an ETF. Instead of trying to play a guessing game and pick the ultimate winning stock, you just buy the market. By buying a tiny slice of the 500 largest companies all at once, you completely insulate yourself. If one company goes bust, it doesn't even matter because the other 499 are still growing. This totally removes the danger of any individual company failing from your portfolio.
Adam Koo points out some super popular vehicles that millionaire investors use to run this exact strategy. For the U.S. market, you've got the S&P SPDR ETF. Most people just know it by its ticker symbol, SPY. It literally just tracks the 500 largest U.S. companies. And for those of you looking at Asian markets, there's the StreetTrack's STI, tracking the Singapore Straits Times Index. These aren't some top-secret insider-only tools, okay? They're totally public, easily accessible funds that let anybody capture the growth of the entire economy. And honestly, the true beauty of this strategy is just how incredibly simple it is. Replicating what wealthy investors do doesn't require a master's degree in finance. It just requires a solid plan and a bit of patience. Step 1, open an online brokerage account. Step 2, buy a broad market ETF like the ones we just talked about. And step 3, hold it for 10 or more years. You don't trade, you don't panic sell when the news cycle gets scary, you just hold. But naturally, you're probably wondering, if you're just sitting there passively holding a fund, how does an average 12.08% annual return actually build massive wealth? I mean, a 12% gain on a few $100 doesn't exactly sound like it's going to buy you a mansion or let you retire at 40, right? To understand how average earners transform into self-made millionaires, we really have to look at the math behind time. And that brings us to the familiar magic of the compound return. You guys already know how this works. Your profit earns profit, and the whole thing snowballs. You invest a chunk of change, it earns a return, and instead of taking that profit out to buy something, you leave it in there to generate its own returns year after year. So the next year, you're earning a return on your original money plus the profit. Then the next year, it's a return on the original money, the first year's profit, and the second year's profit. Time basically becomes your ultimate financial multiplier. Let's put some real numbers to this to see how crazy it gets. Say you invest just $300 a month. In 10 years, compounding at 12.08%, you're going to have a really nice nest egg. But leave it for 20 years, it absolutely explodes. Leave it for 30 years, and that mere $300 a month literally stacks into millions of dollars. The money isn't coming from your hard labor anymore. The vast majority of that wealth is generated purely by your money working for you, multiplying itself over and over and over again. If you want to calculate this for your own financial goals, there's a fantastic mental shortcut called the Rule of 72. All you do is take the number 72 and divide it by your expected annual return. So if we take 72 and divide it by our historical market average of 12.08%, we get 5.96. So what does that actually mean for you? It means every 5.96 years, let's just call it 6 years, your entire invested capital completely doubles in value. It doubles, then it doubles again 6 years later, and again 6 years after that. This exponential growth is so profound that even Albert Einstein reportedly called compound interest the greatest mathematical discovery ever made. But there is a massive catch here, and it's exactly where most people fail. During those early years, the growth looks painfully slow. It really doesn't feel like you're getting rich, and most people just lose patience, pull their money out, and abandon the whole plan right before the exponential explosion actually happens. You absolutely have to endure the slow start if you want to harvest the massive payoff at the end. So, distilling Adam Khoo's strategy down to its absolute core, here are your 3 non-negotiable rules for buying the market. Step 1, buy as early as possible. The longer your runway, the larger that snowball gets. Step 2, hold as long as possible. Because remember, expanding your time horizon is exactly what drops your risk of loss to 0. And step 3, reinvest the returns. Never, ever interrupt the compounding process unnecessarily. Which leaves us with one final thought to ponder today. We've seen that the stock market is absolutely not a casino if you actually know how to navigate it, and that a 12.08% return is historically totally achievable if you just have immense patience. So if you commit to this strategy, if you start buying the market tomorrow and simply let time do the heavy lifting, what's your life going to look like in a decade? What dream assets, freedom, or security will be sitting in your luxury basket? The math is there for sure. The rest? Well, that's entirely up to you.